No.
Got it?
Hi.
So these mics are all, we control them from the back, so you don't have to press any of the buttons, just when you're ready to talk, you lean into the mic, you should be able to hear yourself across the room.
Okay.
Have fun.
Thank you very much. So,
Yeah, can
that one, I
move
guess.
this. Yeah. Someone's phone?
All right. We'll give it one more minute and people come when they come.
Yeah.
Sorry, I should have written down actually your
Very intimate crowd. Yeah.
Arno? Arno?
I think so.
Arno?
I think so.
Are you head of sustainability?
Officially speaking, not. No, I'm head of
I don't know
business
what
ethics.
happened. You had a business ethics,
Yeah,
that's right.
Anne-Sophie is head of sustainability.
Yeah, that's what I thought. So, okay.
But that's fine. I go either way.
I'll just.
I don't think anyone noticed.
Okay, I think we can. I think we kick things off and people join when they join now.
Okay.
All right. All right. There are still some people coming in, happily. But I suggest we start in recognition and respect of everyone who has decided to join on time. And see who else comes in. And hope to obviously keep everyone there to be as exciting and entertaining as possible, and to the extent you can be, on the topic of corporate climate target setting. My name is Jacob Thome. I'm the CEO and co-founder of Thea Finance Labs, a think tank on sustainable finance, and it's my privilege to moderate this panel this afternoon. I'm really, really excited about the people we have here. I know I'm contractually obliged to say that is the case, but I genuinely am. These are all people that bring really unique and fascinating perspectives on the topic, so I'm really very hopeful about the conversation we'll have, and I think we'll be able to touch on a lot of really interesting different components of the question as to whether corporate climate targets still have a future. As way of brief introduction, we have on my very far right Saskia Straub, who's a climate policy analyst at New Climate Institute, a think tank based in Germany. We have Arno Cohen, who is head of business ethics at ING, and Arno is particularly involved in ING's particular situation of being both the only major commercial bank that has a science-based target, an approved science-based target, and also has the somewhat dubious privilege of currently being sued by Friends of the Earth because ING, according to Friends of the Earth, is lacking climate ambition. So we'll hear a lot more about what that reality looks like in the course of the next hour or so. Also very pleased to have Jenny Anderson on here, who is the head of sustainable investment at Lazard. Lazard has been doing some very interesting work around thinking how to assist corporates as part of a new strategy, so we'll look forward to hearing from you about some of that work as well. And then we have Greg Lowe here, who is at Deloitte, Director of Sustainable Finance, and I really look forward to hearing from Greg how Deloitte is thinking about advising their clients now in the current environment as to how to set targets, whether to set targets, and how to design them. So we're going to try and cover in the conversation this afternoon both a little bit of a status quo sense checking of where are we actually right now on these targets. We've seen a number of financial institutions obviously and withdraw from initiatives, but say they're still keeping their targets. We've some people dropping their targets. Some work that Saskia will share with us is about maybe the silent dropping of ambition, or let's say the tweaking of ambition. And of course, all this comes with 2 or 3 major kind of clouds above the target setting concept. One of them is obviously the US political context. The second is the broader question around the viability of the 1.5-degree goal and that as a sensible reference point for targets. And the third are, I think, some of the sensitivities unearthed from the, let's say, green backlash to target setting, where there's, continued critique that targets are actually not ambitious enough, and, that this kind of old framework of you set a target and then you have your stakeholders kind of happy that this is not necessarily working, as ING's case shows. And so all of this leaves a lot of questions as to whether these kind of targets have a future. And then the second part, we'll try and explore indeed whether they have a future or not. Just maybe to kick off as a show of hands, because this panel is helpfully phrased as a question. do corporate climate targets, does corporate climate target setting have a future? So maybe just let's see in the audience, brief show of hands, who thinks, yes, corporate climate targets have a future? All right, who thinks they don't have a future? Okay, so everyone thinks they have a future. The question is what that looks like. Let's see if the panel agrees. And in the spirit of avoiding a moderation style that involves the moderator first giving everyone a piece of their mind before they let the panelists speak, I want to immediately start with the conversation and with Saskia. Saskia, I've been a big fan of your work around actually looking at corporate climate ambition and monitoring targets, whether they're ambitious enough, whether they actually work. I think you're one of the few organizations that actually kind of does the legwork of looking once a target is set, what has happened to it. Can you just take us through where we are right now? What is the state of the art on the target setting, and to what extent is it real or is it fake, if you will?
Okay. Hi. Is
much
better?
yeah.
All right. Yeah, happy to be here today and to present some of the findings from our research. One of our flagship reports is the Corporate Climate Responsibility Monitor, in which for the past 4 years we've looked at a subset of companies across sectors in great detail and looked not only at their emissions targets, but also what the emissions reduction measures are underpinning those targets. And 20 companies across 4 sectors is perhaps not a huge sample, but it's very indicative of what some of the challenges are that are being faced at a sectoral level in the sectors we cover, which are tech, food and agriculture, fashion, and the automobile sector in this year's edition. So some of the findings from that research has shown that when we look at the transparency, integrity, and also progress on these targets, we're not seeing enough happening fast enough. And that might not be a shocking finding to you, but looking into more detail, what's really missing is these emission reduction measures underpinning the emissions targets. So greenhouse gas emissions reduction targets on their own are sort of the standard currently. We talk a lot about scope 1, scope 2, and especially scope 3, and yet we're not really seeing what are companies doing to address those emissions and to address their emissions hotspots. So in the last report, we took a different approach, which is part of our conceptualization around scope 3 emissions and how to address these. And we looked at transition alignment specific target indicators across each of these sectors. So what are some of the key emissions reduction measures that each of these sectors need to take in order to be aligned with a 1.5 aligned pathway? And so for each of these, that's about 5 to 6 indicators that give an indication of whether they'd be able to address a large share of their emissions. And this exercise, when it started 4 years ago, it did start with the intention to also find positive examples of good practice. And we do find that there are indications that across some of these sectors, there are developments happening that we see as positive. And there are some improvements being made across the target setting, targets becoming more specific, emissions reduction measures improving at a different level for different companies. But overall, the picture is still quite bleak, and none of the companies we assess score higher than a moderate score on the integrity of their overall climate strategy. And the questions why that is I think something we've heard a lot about the last 2 days. But part of that is the frameworks that are currently not set up maybe to focus specifically beyond emissions and to actually focus on what do companies need to do to actually transition and reduce their emissions as fast as possible. So right now we're in a really interesting time where the greenhouse gas protocol is being revised. SBTi has just closed their standard consultation on their newest draft of their corporate net zero standard. And there's a lot happening in this ecosystem to update some of these standards. And our main message from our work would be that these target setting frameworks need to become a lot more specific at the sectoral level and a lot more specific to emissions reduction measures and not just greenhouse gas emissions, as these are subject to a lot of loopholes, different accounting mechanisms that can hide emissions and that are not markedly leading to any changes in corporate strategies.
Just to maybe clarify that distinction for the audience, so basically is a different way to say it, a lot of talking the talk and not walking the walk? Is that the sort of...
Definitely. And I think improvements in transparency are happening. There's also a lot of backtracking. But if you look at actual emissions, which are the outcome of measures, they're still increasing across the board. So action is not happening.
Mm-hmm. And maybe it a little bit the extent to which targets were set without necessarily a full plan in mind. We obviously already had the transition plan session previously in the summit, so we won't try and step on too many toes there. Greg, I want to go to you next. So is that also what you're seeing from your clients, basically? To what extent is the tone shifting? Saskia said, we're actually seeing some progress, which is a little bit countervailing to the high-level narrative of sort of backsliding, but obviously the context in which these targets are operating has changed quite a bit. So what is your sense, both from what clients are telling you and maybe, dare I ask, what you're telling your clients, actually?
Yeah, it's a great question, and it's great to be here this afternoon. Good to see so many faces in the crowd. I think the short answer is it really depends. It depends on the client. I look after our relationships and our work across the insurance industry, so life, non-life, health, but obviously, particularly in the life NGI space, those industries are leaning into what's going on across the wider economy.
Life, NGI is?
General insurance, sorry. Mostly an insurance lifer here, so I'll try to keep the jargon to a minimum. In the US, referred to as P&C or property and casualty insurance. I think it really depends on where the organization's based. I think it's fair to say in the question of geopolitics that there is definitely a bit of a split between European domiciled clients and those based in North America, Asia probably somewhere a bit in between. It probably depends on the size and global reach of those clients and just how sophisticated and ambitious their own sustainability strategies are. I think one of the other factors is how long have they actually been thinking about this? I think, there are some clients who gave this a lot of thought even before GFANs came into being in 2021. And I think those, that really had a plan, not only a long-term plan, but, very specific short-term plans, are on track. I think they are seeing the value in it. I think they knew this would be difficult. I'd also probably say that, at least from the clients that I work with, the operational emissions targets are probably generally a little bit more secure. Those tend to have shorter term targets. Obviously, that's not where most of the emissions from my clients come from. Most of that's going to be in the category 15 space.
And category 15 is the greenhouse
financed emissions.
I'm sure everyone knew that in the audience, but I think sometimes where there's a lot of lingo, so let's just to clarify.
So I think it really depends on many factors. The final thing I'd say is where I think our clients are really thinking about this is, and those who maybe didn't give this quite enough thought, where is the connection between the corporate strategy and the commercial targets and their climate targets? Are those things actually aligned? And I think that is a big realization that if you have a particular commercial target to grow your business by X dollars, and in my case, it's usually a client wants to grow their gross written premium for an insurance book. What does that mean in terms of being able to hit their climate targets? So I think that's something the industry is really grappling with. And, I think the things that we're telling our clients are, make sure you link any targets you are setting to your corporate and commercial strategy. You're not going to be successful at achieving that unless there's at least some understanding of the alignment. I think another thing we're often saying is, think about how you can scale the needs of the clients that you serve in your industries. So what are the financing needs of the clients that an insurance company serves? What's not being met? How can they accelerate their essentially the sort of the green aspect of this rather than just focusing on exiting the brown? So I think that's something that is coming up quite a bit. And then finally, really take the business with you. You can't do this in a corporate sustainability team. I think where we've had the most successful pieces of engagement and work with clients are where you have the front office staff actually at the front foot leading this hand in hand with sustainability teams.
It's a little bit of a pointed question I'll ask, but is it kind of fair to say, based on your experience in the last couple of years and what we're seeing right now, if those criteria aren't met, then don't bother setting a target to begin with? Is that sort of, because you can't actually execute it at the end of the day?
Absolutely.
Right?
Yeah.
Okay. I appreciate the point and answer here. So I'm really excited to have Arnaud here with us today from ING. When we talked earlier, Arnaud described his job as there's some people at ING that do the how of target setting, and I do the why of target setting. So we've already heard a little bit about some of the criteria and issues in the status quo from Saskia and Greg. ING is the only bank, is that correct? The only major commercial bank with an approved science-based target. So my question to you is, why?
A very simple answer. And thanks for the invitation, and really keen to have this dialogue with the panel and the audience. So why would we set these targets, and why SBTI? Actually, SBTI has been on our minds for over a decade. I think it was in the weeks before the Paris Agreement, before 2015, in the fall of 2015, that we launched our new coal update, our coal policy update, stating that we would no longer finance coal-fired power plants, so asset-based finance, so the particular asset, no project finance to a new coal-fired power. And we consider that to be a gift, if you want to say so, to the international community. It can be done. We believe that there's alternative renewables, energy sources available at scale, and we can stop financing and developing new coal-fired power plants. Nice, good communications, good marketing. People really love that. It feels good, doesn't it? 2 years after, we thought, well, we can beat that. Let's phase out the whole portfolio. So we got a couple of $100 million in lending and coal-fired power plants. Let's phase it out. By 2025, so this year, €0 lent to assets, coal-fired power plants. Good. We're even going to take it a step further. Utility companies, if you have over 5% coal-fired power in your book, can no longer finance you after 2025. Great, isn't it? And then we got a phone call. We got a phone call from a very concerned government. I can't mention the country, but it was in Eastern Europe. And they wondered, why don't you want to finance our coal-fired power plants? And what's wrong with that? We need energy security. And who are you as a bank to interfere in our democratic processes? We are a democracy here. You are a bank, you are a risk manager, aren't you? So you take our savings from our society and you oppose to put them back into the economy. And please let the thinking up to us. And that was a bit painful, because we really didn't have a response. Well, we did have a response, but it didn't really make sense. Our initial feeling was that ultimately, reading the climate science, there will be an end to coal-fired power. Ultimately, because we didn't really trust governments to take action timely, they're always late. Now, this is a very false statement to make, particularly if you're working for government.
There's some journalists in the room, so ING's position is government is always late, right?
Well, let's put it this way. It is very difficult to get everybody on one line, and particularly if you're in a democratic society, and you need to get everybody on one line to make a decision. So we anticipated governments to be late, but we did anticipate them to act, but act late. Meaning they would be shocked by some event or some political movement or whatever, and then overnight they might want to close coal-fired power and change it for something else. Well, that for a bank is problematic, because when we finance something, different from an asset manager, but when we finance something, we cannot step out overnight. We're in it for the term of the loan, typically 5, 7, 10 years. So to protect the bank, and really this was driven by the risk manager, chief risk manager at the time, to protect the bank, as we know where the world is moving, as we know where the world needs to move based on the Paris Agreement and science telling us where we need to move. We expect governments to be late, but ultimately they will move, and if they do, coal-fired power will be shut and we will still be in it. We've got a problem as a bank. So from a pure risk management perspective, we decided to get out. But then what about this phone call? Aren't you too quick? How to tell whether or not we're too quick? And that's where we really felt that we were lacking the guidance. So this was a bit of a gut feel. We see where the direction is heading. We know what needs to happen. We can safeguard our own book credit risk by stepping out, and let's give them 7 years, but we're out 2025, end of the game. But actually, that's too soon. If you look at climate science, the world's got a bit more time on call. We need not to stop end of this year. So we didn't get the science right. We get the concept right, but not the science. And as we felt that we needed to address not only risk management, but also shareholders, staff members, employees, local employees working in the different countries where we operate, local governments, we felt that the only way to address this topic was science-based. And as such, we signed up for SBTI in the very beginning. Whenever you're going to develop a framework, we're eager to test it and to sign up. So for us, the need for scientific frameworks was very strong in the very beginning.
So you used the word protect in your answer, right? So this idea that kind of the science maybe protects you a little bit or kind of steers you or sort of organizes your frameworks. You're now, as I mentioned earlier, in the curious position where Friends of the Earth disagrees. They, as best as I can tell, and correct me if I'm misspeaking here, don't agree that you're following the science, basically, have sued you in terms of what your current strategy looks like. Both to you as a bank, but maybe also to I know there are some folks from banks in the audience. What do you tell other banks who are kind of looking at your role model and saying, look, we use SBTI, we were sort of protecting here our strategy by, quote unquote, basing it on science, and now you find yourself in a court of law?
I don't think, look at the time. So 26 March, we issued the announcement and a press release, validated targets by SBTI, very proud that we made it after a decade of hard work. Absolutely, still stand behind that. 2 days after, Friends of the Earth issued their writ of summons and took us to court. You need to be very flexible of mind, and you meaning Friends of the Earth, you need to be very flexible of mind to then consider within 2 days, oh gosh, we've been fighting ING for 2 or 3 years in a public campaign. We threatened to take them to court for over a year. Now they sign up to SBTI, or now actually they've got their targets validated. Let's stop it. Let's stop the press. Let's take a totally different approach, and let's use this. Let's flip around the narrative, and let's use it. You can get away with litigation if you do exactly the same as ING did. Sign up to SBTI, get your targets validated within the next 12 months, and you won't hear from us. If you don't, you will. That requires flexibility of mind. 2, it requires great courage, because already they created this awareness in the public domain that this was the next big thing. So first you saw a litigation case from Agenda, another NGO against the Dutch government, bounding the Dutch government to climate targets in Paris. Then it was the famous Friends of the Earth Shell ruling and Shell case, which is still ongoing, by the way, and pending Supreme Court. And the next big thing was we go from government to a corporation to the bank facilitating the corporations. That is very difficult to then stop. So it takes great courage. If you read the writ of summons, I don't think SBTI is in there. I don't think they seek to challenge SBTI so much. To be very honest with you, and I'm also looking at Saskia, I don't even think they want to challenge so much what we're doing. I think before getting our targets validated by SBTI, we've been more or less perceived as the leader of the pack. I don't think really it is about lacking behind that much. And obviously Friends of the Earth will tell there's more that needs to be done, but I don't think that is the key concern. The key concern, my gut feel is, we should invite Friends of the Earth next time, the key concern, my gut feel is that all what we do is on a voluntary basis. So if there is a new board or a new reality tomorrow, we can drop it. There is no legal obligation for the bank to do what we do. And that is the concern. They want a formal title under law to put responsibility and the acts that come with it on the financial sector. I think that's what this case is about. It's not about ING, it's about the financial sector.
Jenny, thanks for being patient. So we've already heard a little bit about what are the different incentives for setting targets, right? Like what's in it for you? And Greg obviously has highlighted like this kind of consistency with the commercial strategy. So Lazard is obviously known for its very bottom-up approach, and it's why it's also great to have you on the panel, because obviously one of the things that you actually spend a lot of time on is looking at companies kind of with the X-ray and really trying to figure out what they're about. Do you care in your framework, and you have this new strategy, right? As part of this new strategy, or do you care whether a company's setting a target? Is that one of the things that's like, yes, this is kind of a checkbox? And if yes, how do you then square that with kind of Saskia's comment around, you know, targets are talking the talk, but not always walking the walk?
Yeah, so maybe just to introduce Lazard a little bit, we're essentially, as Jacob's saying, very much a bottom-up house. So we're mostly public equities and active strategies, both on fundamental and quantitative side, so no passive. And I think it's important when we're talking just to really sort of distinguish a bit between what we're doing broadly across our assets versus what we're doing on specific products. I would say, on the sort of the wider piece, in terms of how our analysts, we have a large global research platform. It's organized by sectors and regions, and the analysts there are fundamentally looking at companies to understand the business strategy and whether we think they're going to be attractive investments for our clients' portfolios. And as part of that, they will consider financially material, human, natural capital, climate, how resilient is this business, how good is its management. And I think that's where they would look at these targets to think about how they fit with the business strategy. And I think that's a really important point is, does this target that the companies set actually help us to kind of understand the direction of travel and whether the company is being successful in delivering its own strategy. And we do see, for companies that have thought about that more strategically, that they're also able to better link it to some of the remuneration pieces as well. And I think, from the sort of targets and the way that we think about that, it would be very much for the things that the analysts feel are relevant to the overall company strategy. I think we tend to, in sort of ESG and sustainable, we can have targets for a whole bunch of things that perhaps aren't always relevant to investors. The second point, perhaps, is more about how I think targets and ESG kind of ratings are being used more broadly in the industry. And I think, often a lot of that kind of activity is quite sort of happening in silo to this more sort of fundamental, broad, kind of mainstream investment universe. And I think that a lot of these targets are being used either to kind of name and shame companies in reports, which we see increasingly, but also used to kind of feed into ESG ratings that are essentially kind of used to package products, based on those ratings. And we know that, typically, that kind of simplistic lens of looking through a company based on that kind of range of data and targets isn't enough to understand whether that business is really going to be resilient in a much more kind of fragmented transition that we see going forwards.
Can I just start one clarification? Yes. You mentioned name and shame or used naming and shaming. So basically targets are being used in naming and shaming by NGO reports.
Kind of NGO reports that call out companies. Often companies that arguably have done a huge amount of work in advancing how each their sector and their kind of area of the industry is advancing the reporting and the disclosures to help investors. So often it's even the biggest companies that kind of get named and shamed the most. Right. And then I think just the last piece is just about how we use engagement. And I think there is a kind of piece around engagement for sustainability funds, and I think that's where you see the kind of companies being held much more tightly to the kind of targets they've set out from a sustainability perspective. And again, that could be where they are either kind of kicked out of, or they kind of make it into a sustainability focused product because they're seen to be kind of delivering and achieving on their environmental and social objectives. So I think they're used in a kind of range of ways by different investors, and I think it's important not to put all investors under one umbrella. I think there's a kind of real different use case for targets. So
when I said earlier that New Climate Institute is one of the few organizations that are doing kind of the public work of looking under the hood of the targets, obviously that is happening in your case as well. We've talked a lot about the corporate side of target setting, but obviously this feeds through into the financial side of target setting as well. I know that you've run a survey recently with some UK pension funds about where they are on their targets. So what are you seeing kind of from the upstream side feeding through to you? where are pension funds on their target setting? Is there some sort of change of mind, and how does that impact sort of how it affects you basically as your business?
And so, what I've heard again today from the panels that I've kind of listened to is that, the 1.5 degrees end objective remains very important for signalling ambition, but just a greater kind of recognition that the 1.5 degrees pathway looks unlikely, and that in terms of practically implementing climate strategies, we need to make sure that we have got more nuance, and we are thinking a bit more carefully about how it applies to sectors and regions to make sure that we're making decisions that are consistent with fiduciary duty and are consistent with delivering returns to shareholders. So it still feels like there's that kind of slight disconnect between the end goal that has been set. Most asset owners have set a 2050 net zero goal. Some have been more aggressive than that. But actually, when you kind of think about the products that have been developed for those clients, we see Paris-aligned benchmarks, which is where most asset owners put a large proportion of their equity allocation into passive. And so they're using these Paris-aligned benchmarks, which are obviously using a 1.5 degrees end goal. We think that they're quite simplistic, and the kind of linear 7% year-on-year reduction, given what we know about this increasing policy uncertainty and fragmentation and the way that the transition is actually playing out, has unintended consequences. And I think we are starting to kind of see a kind of bigger debate around the kind of the feasibility of those types of approaches. I think the challenge is those approaches are have become used quite widely. They're also typically kind of at a fee level that's attractive for those asset owners. But I think there is an increasing debate around whether they are the kind of right solutions. And also there is so much discussion with asset owners about the importance of stewardship. And I think we'll perhaps come on to this a bit more in the discussion. But the reality is that stewardship, in my view, really does need to be kind of driven by portfolio managers and analysts that own the shares. And I think you kind of see a very different dialogue with company when you're having that strategic conversation, as opposed to when it's being conducted in silo by an ESG team or a collaborative engagement. I'm not saying that there isn't kind of a place for different types of engagement, but the engagements that we have, which are led by our portfolios and analysts, 100% of our engagements at Lazard are led by our portfolio managers and sector analysts. And I think that that is a really important part of companies understanding how investors are thinking about this, how they're thinking about where it's going to impact financial productivity. And so I do think that where asset owners have put so much focus on their passive equity allocation, there is this kind of disconnect with the value that they also put on stewardship, being able to kind of deliver on climate and environmental progress.
Greg, I want to bring you back in as we had this survey at the beginning of the panel asking the audience whether they thought, corporate climate targets have a future, and everyone thinks the answer is yes. Most of what I've been hearing so far has been about corporate climate actions have a future, right? So we're talking about stewardship, we're talking about the different kind of, what's underpinning the Science-Based Targets Initiative. Saskia has been talking about, what they really care about is, well, are emissions going down or up, basically. Greg, you've talked about the integration of the commercial strategy. So how important is it, do you think, to set targets, actually, versus just doing the thing itself?
Yeah, I mean, look, it's a good question. And I think what part of a business doesn't set targets to help them achieve results on whatever topic that might be? HR departments have targets, finance departments have targets, front office teams have targets. I think the question around targets is around, are they actually practical? Do they help the people who are responsible for delivering them do their jobs better? I mean, we're basically talking about performance management. And I think there's a lot of this nuance in terms of, how a business actually operates in terms of, what are the different functions that are going to actually help them get to that target. And I think the question of, are targets helpful? They are helpful. They hold people to account, but it has to be something that they're actually held accountable for. No one is being held account to a 2050 target. But people hopefully are being held to account for, a 1 to 2 year target. So I think it's breaking that down into much more digestible pieces that are really relevant to the folks within an organization who can actually help drive and execute change.
So have we done basically, if we look back on the last couple of years, have we done too much, high-level panels, 2050 targets, let's put the brand out there, and not enough, okay, what performance management are we striving for in our sustainability strategy? And then let's put a couple of KPIs on that we're working towards over, let's say, a 5-year time horizon. I know you mentioned 2025 as a time horizon for your original coal strategy. So is that sort of the key re-equilibration that's needed right now?
Yeah, I think so. And look, I think on a related but not entirely separate topic, even around scenario analysis, I think there's a little bit of an aha moment starting to happen in the market on that. I worked with several clients on their stress and scenario testing under the CBES initiative. For anyone who's not aware of CBES, it was the climate biennial exploratory scenario that the Bank of England put out in 2021. Major banks and insurers had to do some stressing of their portfolios. It was very top down, and I think the collective response from the industry was this wasn't particularly helpful. No one really believed the numbers anyway. There is a consultation on kind of re-looking at stress and scenario testing that the Bank of England is currently looking at. And interesting, the Bank of Ireland's done something quite different. Instead of saying you have to run 3 NGFS scenarios, actually think about the narrative. Let's do this bottom up. Let's actually describe what we think might happen and what is our perspective, what is our house view. So I think that same realization of going bottom up rather than top down is where the market should be thinking. And I think for those who are actually doing some really interesting work, it is what they're looking at, because I think we all know that getting to net zero is going to involve systemic change, and we're talking about interlocking systems. And if we're just talking about the ability to get X number of trillions of liters of SAF, what is the ecosystem that actually needs to be set up to be able to produce that? So I think some of that bottom-up thinking,
SAF is
sustainable aviation fuel.
Thank you.
And that's some of the discussion that actually really needs to be happening of what are the building blocks that need to come together to help us achieve something, and what can we do to help one particular building block of that system, whether that's electrification of heat, whether that's ammonia or methanol for shipping, and what are the barriers and blockers that are happening there.
So, and I think it's worth, I recommend to the audience the PRA consultation paper that Greg is, I believe, referring to, 1025. It's quite an interesting read because similar to the European Banking Authority guidance from earlier this year, it really pivots the focus from top-down, this is the NGFS scenario, to justifying your scenario, kind of ownership, which I think interesting is also as we see, maybe there's a bit of a pushback against harmonization towards real ownership in this context as well. We've established, and we'll see if that is contested by the other panelists, but we're hearing that we need to sort of look towards more short-term target setting, and that this should be more like a performance management system rather than a kind of a high-level panel. I know you obviously are talking to your peers in the banking industry all the time. The problem, of course, with saying, hey, maybe the 2.0 of target setting is really this focus on short-term and maybe a little bit less of a conversation of who's got their net zero 2050 target. The problem is this flies a little bit in the face with the, let's say, broader mood, which is, I think, in some markets, notably in the United States, turning against climate. There's some question around some of the electric vehicle deployment in Europe, and there's sort of a lot of, Jenny already mentioned this sort of fragmenting policy environment. So how viable do you think it is now within the banking community and within your peers to go back and say, and to go back to your CIO, to your CEO and say, hey, great that we've set this net zero target, but really we now need to push hard on some strong performance metrics for until 2030 in light of this tension that we see more generally?
Yeah, when you tend to listen to these talks, sometimes you get a feeling that we're back to the 90s.
Which was a great time.
Which was a great time in many respects.
Maybe not for climate, but for music.
I was in university at the time. I'd love to go back there. And it was the time of Freeman and good discussions and stakeholder and what have you. And now it seems to be that we're back in shareholder paradigm, or back into just apply the law and no more than the law, please, and the law will tell you what to do and not beyond the law. But I think we've passed that station, and we shouldn't go back to that dialogue. I think in ethics, we can argue 10 different ways that businesses and banks have a form of responsibility, whatever it looks like. I think in law, we can argue that there is a responsibility, whatever it looks like, and yesterday that was discussed at depth in the panel as well. I think it is, for the economy, it is very relevant to understand returns and risks, but also returns, short-term and longer-term, but even short-term. And for a fact, the physical impact is for real. So all the parameters are there, and then we are struggling because, hey, someone made it political. Well, of course it's political, because there is real impact on people, and we need to discuss the trade-offs. And if you look at the Friends of the Earth case, again, it's not only about what we do, it's not even about setting a standard for the financial sector, but it is also about who's going to pay the bill. The whole campaign is about, let's have the large polluters pay. That is a political message in itself. So probably this is not only about science, but it's also about politics and trying to understand the political movement. It's a fact of life. Politics is all around us, and it should be, because it really matters to people what we're doing here, which is a good thing, because we're having real impact. Now again, back to your question, so what do we do with the targets then? I feel that those targets can explicitly help us, particularly as we are in a gray area where politics are moving, where the discussion on who's going to pay is moving. In that gray area, you don't get guidance. And if you don't get guidance and you need to act nevertheless, for all the reasons just mentioned, science is able to help us out, at least what it may look like. So it is this dot on the horizon that keeps us heading in the right direction.
Going out to the audience, we'll have a more general Q&A later, but I just want to already flag up to you, because I didn't at the beginning of the session, apologies for the oversight, that we're happy to take questions from the audience. So if you have some, you can start thinking about them. And we'll do one other thing. If there's anything a panelist says that you personally strongly disagree with, feel free to just quickly raise your hand and I'll take a note and I'll try and weave that into the conversation as well. Or even if you just think there's sort of a big missing topic, keep it short and concise, because we want to make sure we have enough time for everyone. But I do want to also not oblige the audience, as you often want to do, to just ask a question, which inevitably leads to some audience members phrasing a comment as a question and some awkward side eye. So prepare your questions if you have them, but also if you have sort of a short-term big disagreement or something that you think is sorely missed in the conversation, feel free to just sort of flash your hand and we'll try and weave that into the conversation, not have to wait until the very end. Saskia, over to you. So we're starting to already now get into the topic of, more short-term target setting as one aspect, and some of the ways we can kind of fix what's broken. What do you think from your research? You've already sort of alluded to the fact that, well, the way to fix it is for people to actually do the work, but there's obviously something that's missing here. Like, there's a reason why companies aren't doing better than moderate on your scoring, So is the problem that moderate is kind of the best companies are going to do in the current environment? Is your scoring too ambitious? Or is there some things that you think, look, this is absolutely doable and eminently achievable, and that actually you could get a much better score if you did some sensible commercial strategy integrated business decisions?
That's a very good question, and I would say that just start by explaining that the way we look at companies is that we look at companies that have a net zero target, and then we go from there and say, what would it take for them to achieve that according to our understanding of different sectors, and in light of achieving deep emissions reduction cuts instead of maybe other methods that are sort of used as loopholes like carbon offsetting, which we can start a whole debate about. But the message is that there are a lot of actual measures that companies can take, and that's very sectorally specific, so it would be hard for me to make a specific claim, but there are measures that are being taken, and they are also being taken by some of the leaders in the fields. So there is progress, and to this point about maybe sort of, are we asking too much? I would say that we often hear this narrative, don't let perfect be the enemy of good. And I personally don't agree with that at all, because I think it's a very dangerous, slippery slope in which we don't value the work that is being done by those who actually want to take steps to transition, and in which we can very quickly fall into a race to the bottom instead of a race to the top. So what we really want to do is set high standards, acknowledge those that are putting in the effort, and encourage those that are not yet there to look to their peers and to level up instead of falling behind and using strategies that have questionable outcomes. And so I think it's not necessarily that there's nothing that can be done. There's lots more that can be done right now. We are 10 years from Paris. We're closer to 2030 than we are to Paris now. And that's frightening, because in that time we've seen these big net zero commitments, and yet we're still trying to get to grips with what does transition planning look like, and we should be much further talking about the 90s. If these discussions were happening in the 90s, I would feel much more assured that we have time to develop the perfect systems. But now is the time to act rather than to be talking, and we do have to talk, so I'm happy to be here to talk about that.
So you disagree that, but I guess, you've this complexity, right? That every sector has its own story, and when you're actually doing I think part of the reason why the kind of assessment that you're doing, this corporate climate responsibility monitor, it's called, right? So is not done more frequently because it's hard, right? It's not just a trivial box ticking, but you actually do sector specific. And again, I mean, Jenny, you as well, of course. This is not, otherwise everyone in the industry would be doing it if it was easy. So it's hard, but maybe it also speaks again to the topic of, we've been very focused in the world of target setting around setting guidelines, having these global frameworks, having these kind of net zero initiatives that sort of lay down here is how to do it. And that's also been part of the problem, because it's not just the sectors that are idiosyncratic, there are different markets that are idiosyncratic, there are different policy environments. Jenny's already talked about the sort of fragmented policy environment. So should we, as we think about the future of corporate climate target setting, one of the things is maybe be a bit more short-term, more performance management thinking rather than panel thinking. But should we also give more space to letting companies kind of do their own thing, if you will, for what's right for them? Or is that kind of opening the door to more greenwashing and free-for-all? So where do we kind of put the needle in between, I think, what was a little bit conflicting views that you're sharing here?
That's a good question, and I would say that the current status we're in is that we do have a governance system that can validate different aspects of voluntary targets.
I'm sorry, when you say we, you mean you or?
I mean the world.
Okay, not specifically. Okay, right, yeah.
Yeah. But underlying that system and those rules that we've set up are a lot of power dynamics and different vested interests and different ideas of what the transition should or could look like, and maybe an attachment to the world we currently live in, and in hesitancy to transition to the world that we need to live in. And there are different ideas and expectations of what that kind of economy or society would look like. So when we say it's based on science, as Arnaud already pointed out, science is political in a sense that we have different values and we have different expectations. So no, I don't think we should just let companies do whatever they want to do, what's best for them. Yes, I do think that it is very individual on a company basis, but there are certain standards and expectations that we have at a sectoral level which have crystallized and which are very clear, and there's no reason to not be following that guidance when we know the urgency that is pushing this forward.
Of course, part of the challenges to the guidance, and we've already touched on this, is the 1.5 degree reference. There's, Jenny, you already, you have highlighted this seems to still be a reference point. It's obviously part of the panels that we had here at Oxford, but at the same time, I think if I had a poll of hands who thinks 1.5 degree no overshoot is still a realistic goal, I'd get, well, let's do it. Who thinks 1.5 degree no overshoot is still a realistic goal? Everyone, yes, put your hands up. All right, so for those of you who can't see the crowd, that was 0 hands and 1 person who thought about it for a second and then I think felt the peer pressure. So, you know, obviously, as part of the performance management, you have to decide what ambition you're going to set. So, especially when we get to more short-term performance, you know, targets, you kind of have to then say, all right, we know what the climate science is telling us, but to Saskia's point, the political reality, maybe not 100% there, Jenny. 100% there, Jenny. I want to ask you about how you think, you know, when you're trying to bridge the sustainability portfolio management team. You've obviously done some work on this, and so how are you trying to sort of navigate this loss of an anchor?
So a lot of the comments I made probably are closer to what we're doing on the fundamental portfolios, but we have worked with our quantitative investment team that are obviously looking across a much larger universe to understand how some of our in-house proprietary models can help us to have a more holistic view on a company's transition and resilience potential for essentially a core equity solution that we've put together. And we really are trying to think about the kind of whole spectrum of things that we should take into consideration to sort of have that kind of wider view on whether the company is kind of well positioned or not. So essentially it kind of has about 5 proprietary models, has a controversies model and a greenwashing risk radar model, which is quite interesting. I think, you know, from my perspective, some of the stuff, the techniques that the quantitative team can use now with language models to actually look at what companies are saying in their sustainability and regulatory filings versus actually what they're doing. We've come up with a statistically relevant model that is built into our climate advantage strategy. But then we also have a transition model that's in there, bringing multiple data sets. We don't think that there's one kind of data provider that can give us a good picture. We're trying to make sure that we kind of take that holistic view. It's using kind of the external large data providers that you would expect us to have access to, but also bringing in the NGO data sets like TPI, SBTI, etc., and trying to kind of complement those together to give us a holistic picture. And then we also have a sustainable revenues model, which is built using the insights from our fundamental analyst platform. And then we combine that with our standard financial model that we use across our quantitative platform, across our advantage platform, and we marry those two things together. So we're trying to find companies that still look financially attractive from the 4-factor model, but combining it with this, we call it our climate navigator. So companies that we think overall are well positioned, and it results in a diversified portfolio of stocks that we think is a good solution for investors that have been using this kind of passive 1.5. We don't have a kind of 1.5 goal for this portfolio. We have a goal to be investing and allocating broadly across the economy and across the universe to companies that we think are actually well positioned versus their peers. So we think that's a kind of a more nuanced way to think about it, and it also starts to get away from some of the challenges that we think that the passive PAB kind of type solutions are going to have with this increased tracking error, increased kind of sector bets that are being taken. And so, the Paris-aligned benchmarks. And I think just maybe going back to the question that you asked earlier, Jacob, about clients and where they're at with their own targets. It's really interesting that a lot of asset owners have already met their net zero targets. They're on track. So, they've got a 50% reduction by 2030, and by putting their equity allocation into this Paris-aligned benchmarks, they've kind of met their targets early. And I find the fact that emissions have continued to go up in the real world economy during that period, but because these are based on Scope 1 and Scope 2 emissions, that the asset owners have kind of met their targets. And I just question, what does that really mean? I think that the thing that's happened, or the discussion that's quite interesting, and Jacob referenced that we did a client survey and we held a workshop in our office in London for clients a couple of weeks ago, to me there's still a kind of question mark about the objective behind this, and whether it's really about asset owners trying to kind of address climate risk, Or is it about actually managing stakeholder and reputational issues? And I think that actually is kind of quite a lot of kind of blurred a kind of rationale and decision-making happening in the middle of those two things. And I think that's kind of perhaps why we've ended up in this situation today, where I think a lot more asset owners are starting to think about how do we actually refine, how do we do something a bit more nuanced and a bit more sensible, that's a bit more tailored for each asset class, or a bit more, how do we think more thoughtfully about emerging markets, which, is a kind of casualty of these top-down targets, because the carbon budget is not compatible with having a kind of a higher emerging markets allocation. So I think there's still we've made the way that asset owners have gone about this is, kind of in the last 10 years has significantly become, much more part of their strategy and their investment beliefs. But I do think we're at a point where we need to think about have we got the right end goals, and while we're doing implementation in a way that's consistent with fiduciary duty.
So I wonder, when we get Saskia's report in 5 years, whether maybe we see some lower emphasis on 1.5 or the ambition level, but maybe a little bit less talking, a little bit more walking. I think there was a hand there in the audience. So why don't we take the two hands just to sort of mix it up a little bit. Just briefly introduce yourself, and then we'll bring it back to the panel. Go ahead. There is a microphone, and it's actually coming right now, so just give it.
Hi, I'm Christian from Golden Capital in Munich. A question to Jennifer. As you anchor your strategy to 1.5 degrees and the asset selection that's driven by that, how do you represent to your investors that you will end up with a portfolio that's most likely full of companies over-investing into that promise and as a result, arguably underperforming on the equity returns that you deliver on that route? So how do you square the belief versus the economic reality if you anchor yourself to what's baseline in the market?
We don't anchor the portfolio to a 1.5 trajectory. Was that the question?
Yeah, sorry, that's how I understood your Paris-aligned benchmark, 1.5 degrees screening, all the best companies go into the portfolio. Did I misunderstand your proposition?
So the Paris-aligned benchmark has that process of screening companies based on emissions and optimizing down over time to kind of meet that 7% linear reduction. I mean, that's completely what we're not doing. We're using kind of bottom-up models that help us to identify which companies we want to hold, both from a financial perspective and a climate resilience perspective. And actually, you can see through our own assessments that you can look at the alignment spectrum, and we use the net zero investment framework to kind of understand whether companies are moving along that alignment spectrum, but we're not trying to manage it to a 1.5 end goal.
Did that answer your question?
Yes, it did. Thank you.
Okay. I think, Christian, probably part of your question relates to the fact that if you were doing that, it would not be very possible to reconcile these two issues, right? We'll take another one up here. I might then bring it back. Let's see. Well, we've got two more, but let's see how we go.
Thank you very much. I'm Nathan Darabasity from Rotterdam School of Management. I have a very stupid question, which is, why do we consider that 1.5 should be the focus? Because the fact that we're overshooting and that we're going well beyond 1.5 should add some urgency, not less urgency to the matter.
So you think we should not have 1.5 as a focus?
No, but the question is really moot by the situation.
Yeah.
But it doesn't mean that net zero loses relevance or lose any urgency. On the contrary, it adds urgency, and companies should be much more, I think, because the more we overshoot, the more it's going to cost in terms of adaptation for all the companies. So I'm trying to get a bit of sense from the panel whether 1.5 is really the right focus, or should we just focus on net zero and stop having these moving targets and I don't know. It's a stupid question.
Let me just do yes, no first, just to kind of get the sentiment, and I want to pick up one or two things I see, so we'll get back to your twos in questions in a minute. So should 1.5 still be the reference? Let's just get a yes, no.
No.
Investors, no.
Yes.
All right, so there you go. Brilliant. Everyone always complains, oh, everyone agrees on the panel. Well, here we go.
But maybe then good to highlight why.
That would be a good follow-up question. You should have been the moderator.
I'm happy to reflect on that one.
Yeah, so let's do a quick why. That's a good. Thank you for highlighting that.
You just made the comment that science is political, and I tend not to agree. To me,
Another disagreement, I'll note for the.
Science is science and should be fact-based. But I do see where you're coming from. When we feed science into the Conference of the Parties, the COP meetings, then it becomes political. So the Paris Agreement and the 1.5 degrees target, that is political, but the science behind it is not. So pending, that's one. Two is, we are not a democratic entity in society. We have no voting power. I have, as a citizen, but representing ING, I've not. So we feel it's not up to us, because we don't have political mandate, to opine on 1.5. That is up to the parties. That is up to the United Nations and the governments of the various countries. So if the UN sets a 1.5 target, that is what we will copy and seek to copy. Even if it's no longer feasible, it's not up to us to come up with a new target. So what should we copy tomorrow? 1.8? 2.1? I really don't know. And I should... Well, yeah, but after Glasgow, it was targeting 1.5. So we go with the UN, unless up to the very moment that the UN decides that it should be 1.7, or that we allow some overshoot and then have to flip back to 1.5. It's not up to us. In this gray zone time that we're currently in, because I see your point, we are passing 1.5 and everybody agrees, and what to do then? We go as much as we can with science, and we call on governments to provide guidance and clarity. But I do like to put this to two aside. Otherwise, we get very mixed discussions.
Greg, I want to let you sort of reflect on your answer, but maybe also tie back in something that I think was really interesting about what Jenny said earlier, is about this confusion about risk and impact, right? Because the way you've really framed climate target setting is in the performance management. I thought that was a really quite intuitive way to think about it, right? But of course, the performance management, sure, you can have non-financial performance management in a company, but it is very much anchored in the business, right? Whereas a lot of the targets that have been set have played a bit broader role, right? They've tried to have a positive impact on society. I mean, that is central to the discourse that ING has around it. You know, as much as you say you're not a democratic actor, you obviously have an agenda with your work that goes beyond the narrow dollars and cents, even if it may be anchored in it. So is this part of the tension in the question, actually, is that, you know, we've sort of treated the panel, the design of the panel, myself, have treated the sort of targets as one thing, but we're really talking about two buckets, which is what do you want your kind of impact targets to look like? And maybe they play a bigger role in signaling to policymakers what we would like to achieve. Maybe they can be more long-term. And what do our kind of performance management targets look like? Do you agree with those? Can you unpack that for us?
Yeah, I think that there's a huge tension in those things. So, you know, when I think about performance management and kind of coming back to the, you know, the heart of the business issues, where the front office will drive a lot of this activity, and you know, certainly in the financial services sector, those things tend to be about commercial opportunity. Now there is obviously, you know, the whole financial sector is based on realizing, you know, financial gain from taking risk. I would say that there are aspects, you know, and we did a paper on this with my former employer Aon earlier in the year around how the insurance industry has actually kind of, I think, lost its historical culture of wanting to take risks and underwrite new technologies that could kind of forward that. So I think that's certainly a discussion. And then you kind of, I think you're also looking at this question of risk management on the physical risk side. I don't think there's really the connection on those two topics right now. I think you do see that in the Bank of England CP 1025 paper that Jacob mentioned earlier, the consultation paper, and they are asking financial services organizations, specifically insurers and banks, to think more about how do you link scenario analysis to strategy, because that is really missing at the moment. And it's interesting, when I remember kind of the origins of TCFD, which had a little bit of an insurance story in it. But I think the observation was there was a punt that, carbon taxes or, putting a price on carbon was not going to be, widely implemented enough across the global economy. Let's actually, put a risk number in a balance sheet around physical climate risk. And maybe that will actually help focus the minds. I'm not sure it really has, but I think if you did have kind of questions around, capital management and reserving, and if physical risk was a part of that, that could potentially drive some behavior. But there is that, I think, inherent tension between, what does the science tell us now what this means for the financial impacts of our organization, and then what do we actually do about how we're deploying, our own balance sheets and capital. That is a conversation that's not really happening, and I think even the kind of second and first line ownership of what's owned by risk, what's owned by the business, and how do you square these two things is a real mess at the moment.
It reminds me of an anecdote from a philosopher of wine that does exist apparently as a job, who told me once he was at a wine conference and somebody handed a glass of champagne and he had a sip. He said, "Oh, this is the worst champagne I ever had." And the waiter said, "No, sir, it's not champagne, it's Prosecco." And he said, "Oh, this is one of the best Proseccos I've ever had." So if you're thinking about targets from a risk perspective, then they can be very ambitious. If you're thinking about them from an impact perspective, the champagne, if you will, then they might seem very mediocre. We've asked the panel the answer to Nathan's question about 1.5. Let's bring it back into the room. So we had a 50-50 split here. So just quick show of hands. How did I frame the question? Who thinks 1.5 should still be the core reference point in target setting? Quick show of hands. Who thinks it shouldn't? I read that as about 70-30, something like that. So 70% still think it should and 30% don't. Saskia, when do you think we should, because you also obviously agreed with Arnaud, but what is the policy moment, the moment to drop it? Is, if in Brazil, they say 1.8, is that the moment to say, okay, now it's 1.8, or do we need to do something beforehand? What is kind of, if you are advising companies, banks, or investors on the 1.5 reference point, and again, from the vantage point, let's say impact target setting now, not the risk target setting, what is your, moment where you say, all right, time to drop it?
That's a good question, and I just want to start by reflecting that I also have been having this question throughout the past 2 days of how easily we're just accepting that we're moving beyond 1.5 and that the consequences that will have maybe aren't fully appreciated, and that I think that targets are really important, and at a global level, at an intergovernmental level, it's really important to have a target, and that we were able to reach an agreement that we would aim for 1.5 is really phenomenal, in a sense that we have so many different actors and coming together around something that gives us sort of a North Star of where are we heading. That's really amazing. However, at an operational level, at the company level, how do you scale down a global average emissions increase target to a company? What does each individual company, how do you determine if it's 1.5 aligned? And what kind of benchmarks are you using to determine that? These are real questions that you can have, and these are real questions that we face. And I wouldn't necessarily say the answer to that question is moving away completely from 1.5. We have 1.5 now. We have a average temperature goal at a global level, and we can try our best to scale that down to a sectoral level. And from there, we can try our best to understand what companies are doing and how they are aligned with maybe the expectations we have for that sector. And 1.5 remains the most ambitious scenario. It remains the scenario with the least overshoot and the least emissions removal technology reliance. And that remains the goal for us, from my perspective, mitigation over adaptation, over loss and damage. And from that perspective, it might not be perfect, but it's what we have, and we should try our best to keep that ambition and keep that drive.
So that's didn't 100% answer my question. That's all right.
Your question was, when should we drop it?
Well, in what for you is the sign, right? It's not like a norm. Just if you're a company, kind of reading the news every day, when is the moment when you should say, call your CEO and say, all right, bets off, UN has said it's now 1.8, you know, to our nose reference, or something else has happened, or we physically crossed the threshold maybe, or you're also fair to say, I punt on the question. I'm not going to make you answer it because it wasn't in the notes of the prep.
I have the privilege of not being a company and being a think tank researcher who looks independently at the best available science that we have, that is the least influenced by vested interests, that is the most objective as possible, but in some sense will, in my opinion, always be political in some sense. So I thankfully don't have to make that call, but I would say keeping the highest ambition for the deepest emission reductions as soon as possible is really what we need to prevent a lot of harm.
Let's take 2 more questions from the audience. Oh, there are a lot more now. All right, great. Let's take a couple more questions, and before we answer that, I think why don't we take 2 or 3 just to sort of, there's one gentleman here in the front, and then the gentleman, Alex. The gentleman, Alex.
I think this 1.5 degree conversation, I mean, it's because crossing the threshold is going to lead to irreversible damages to the planet. I mean, it's not like we just sort of move the radar around depending on what the economy can deliver or not deliver, right? I think that's based on science, and that's the science that we are backing, and that's why we have that ambition. So, I mean, yeah, we can debate like it's 1.7, 1.8. The science says if you cross that threshold, you're going to have irreversible damage, which is why we are trying to like hold these companies and financial institutions accountable for this, right? But okay, anyways, to a separate point, I work for the FAIR Initiative. We're an investor network, and we also assess companies, and we help investors sort of do collaborative engagements and so on. I think the question I have is that...
Maybe stand up, by the way, just so it's
sure,
a bit more...
the question I have is sort of like, I think Jennifer sort of mentioned that. I mean, instead of treating like the corporate targets and disclosure as a separate entity, like, are you also trying to look at the financial materiality of like those disclosures on how your assets are performing? And if that's the case, then you can have a bit more of a better approach in terms of looking at those physical risks and transition risks and others, right? And then I think this makes a bit more sense than like having a box ticking exercise as to like they have a target, they don't have a target, and then we have like your returns on the other side. And also the other question is, do you feel these corporate targets and disclosures at the moment is allowing you to sort of make those decisions or integrate that into your thinking around financial materiality?
Before you answer, if I may, Alex, why don't you just pass the mic across, and then we might take one more question, and then we'll...
Hi, I'm Alex Clark, Head of Research at Asset Impact. Among other things, a lot of the stuff we're doing is comparing, you know, what asset-based data tells you versus what corporate targets are saying a company will achieve. But it seems to me that it's clearer now ever than it was before, even, that, you know, corporate targets kind of fall into 2 buckets. One of which is a company's well on its way to achieving something, so it's kind of softballing everyone and saying, you know, we're going to achieve 50% less emissions or reduce our emissions intensity in the power sector by 2030, but they would have done that anyway for reasons independent of climate. And the rest was implicitly conditional and is now very clear that it's explicitly conditional. On policy, basically, on external events. One of the interesting comments from this morning was, would it be helpful for an evolution of the SBTI framework or something like that, to not only have a target, but to have a very clearly worked out set of conditions that must be met, whether that's a carbon price or something else, and to have really done the homework on what that carbon price needs to be, or, you know, whatever other condition, for the target to be achievable. And it seems to me that would provide a lot more useful information to investors as well. And at the moment, it's kind of, it's devoid of informational content, really, to set a target, particularly if it's past 2030. So curious as to your thoughts.
I think you had your hand up as well, right? Let me just take the question here as well.
Yes, Tessa Walsh from IFR, International Financing Review. I was very curious what the panel thinks of the targets that have been set on sustainability-linked financing and whether they're fit for purpose or not.
So the more asset-based target. And just because we're having such a good time, let's take one more question here from the gentleman in the checkered shirt.
Thank you. David Barnden from Equity Generation Lawyers in Australia.
Yeah, so if you come all the way from Australia, obviously we got to get you to ask
well,
a question.
thank you. Yeah. Look,
Otherwise, it would have been a long flight back.
Indeed. No, I appreciate it. I mean, the law is developing in terms of duties on companies and directors and states.
Do you mind getting up as well? Sorry, I think
Sure.
it's nicer for the audience to see you as you ask your question. Thank you.
And in some cases, like the Friends of the Earth and Shell case, the court rejects these sort of hard standards like 75% reduction by 2030. But so what's happening in international law? For example, in the law of the sea, there's an advisory opinion that says states need to use their best efforts to reduce and control greenhouse gas emissions. And maybe is that the standard that investors, given their social position in society, should be seeking to do?
Wonderful, thanks. So I'm going to let folks respond to these questions as we come around. So I think I will just kind of pass it across the table, and feel free to respond or engage with comments or questions that you've heard. Oh no! Well, there's a recording, yes. So this is, which I'm sure you'll then go to minute. What minute are we in the recording? So she can skip the first bit, 1 minute, anyway. All right, let's kind of pass the question across, and I think also in the spirit of the question, I think we want to try and sort of, as we get to the last 10 minutes of the panel, really kind of nail down sort of what, if you're a company, I think we've already, centered on the short-term targets as one aspect, but I think it's interesting to comment around, well, from an impact perspective, that long-term reference point is still very important. The 1.5 reference point is obviously something that we've talked about quite a bit. Again, the sort of risk, not necessarily versus, but sort of why are you setting the target? Arnaud's illustrated that quite nicely, like what motivates that target? And then how do you manage what you're trying to do in your business? I think picking up already on Alex's point, like what actually, your target at that point is something you're trying to achieve anyway, so that's sort of softballing your target. But on the other hand, it's your performance management system. When you set an HR target, it's something that you intend to achieve anyway as well. When you set your other targets, that's true for your kind of performance management targets as well. So this kind of like finding the right things that fit your business versus the desire to have that global validation, whether it's Science-Based Target Initiative, whether it's a great score from your Corporate Climate Responsibility Monitor, whether it's PCAF, you name it, right? So I think these are all the issues that we've been dancing around or that we've explored as we wrap up responses to the question, but also, if you will, sort of where do you land on what companies and investors should do in this matrix of short-term, long-term impact risk and harmonized versus idiosyncratic? Oh God, that's the worst mistake of a moderator, 5 questions in 1 question. I can't fix it now, it's too late. Greg, why don't I start with you and then we'll go across the table.
Well, I want to pick up on Alex's question because I think it's a good one. And it's something that I've done in strategy with clients more widely, but I think it's a good question for everyone to ask. If you're looking to reach a particular outcome, what needs to be true for you to be able to get there? And I think that's a question that's not being asked often enough. In any kind of, sustainability strategy I've worked on, but I think, even my colleagues who do kind of, core management strategy, that's a really important question. And it comes back to, I think, some of the points I was talking about in terms of systems. And, if you're thinking about something like SBTI, what are the collaborations and system requirements for you? What needs to be true for that to actually happen? And I do think that's very much a bottom-up question. I don't think there's enough cross-industry collaboration. When you kind of look at sectoral decarbonization pathways, there's all the dependencies in other sectors. Not every organization is necessarily going to be able to ensure that their dependency on one sector is met, but what are the things that you can do? So I 100% agree on that point. I do also agree with the point, I said 1.5 is not necessarily something to kind of be wed to, but I do agree as a North Star, it certainly is, still a helpful point of reference. So there's a little bit of nuance in my response to that. And I think in terms of, the legal point, that's a very interesting question that worries me slightly in terms of target setting. And the reason I say that is very much from, an insurance perspective, but it's a very live question at the moment. With directors and officers and liability coverage. And I think there's a little bit of a moral hazard there where I think, the insurance industry is sort of saying, we don't want to be sort of liable for huge types of climate litigation. They're trying to kind of cut all these things out. I think, do you actually get a situation where that kind of scares everyone away from kind of making commitments because you either won't get insurance coverage for that, or it will cost you a little bit more money. That's a fairly technical point, but it's something I'm hearing a lot across the markets. And on the risk point as well, Everyone talks about physical risk and transition risk. Litigation risk kind of covers a bit of potentially linked to either one of those things. I do see it being discussed in the insurance sector. It's something that a lot of my clients are very worried about. When I speak to my colleagues who work with other sectors, it doesn't seem to be quite as widely discussed, but maybe they're just not hearing about it yet. So sorry, that was a little bit of a hodgepodge of all sorts of different answers.
Much less of a hodgepodge than my question, so you're already improving. Jenny, you actually got a very precise question about the financial performance relationship, right? So why don't I let you respond to that and obviously weigh in on the other topics as you please.
I have asked our quant team to run some of the analysis about the extent to which our climate alignment models help to, so this is a specific part of the kind of broader strategy that I mentioned. And at the moment, there isn't kind of a financial sort of signal from that, but we can see that the companies that perform better are actually also kind of decarbonising faster. So we can see a kind of real world potential kind of impact from looking at that particular model. Maybe I could just say two other things kind of in relation to the 5 questions. One is...
Just one more follow-up to the gentleman's question. Is that, do you think, because it is actually idiosyncratic, right? Like in some cases... I think
it's idiosyncratic, and we expect it to be more of a forward-looking issue, and quant are always kind of the empirical research kind of doesn't show them enough, and they're so kind of the threshold for what they put into their models. Their greenwashing model is actually financially significant, and there's a kind of additional basis point return from that strategy. So it depends, but I think it is partly about kind of having a belief that those companies going forwards are going to perform better. So I think that's important with quant. It's always kind of empirical based. Yeah. So there's the kind of 2 points I think from my perspective are this distinction between the risk and the impact, and actually for investors and other actors to be clear on what the objective is, and maybe you have both types of targets, but actually we are at risk of, because they are conflated at the moment, we do have this risk, I think, of being exposed to a lot of the criticism that is coming at ESG and sustainable finance. And I say that as somebody that kind of really sees what's happening in the US. We're a US firm, and I can see that until we do have that kind of clarity from an investor perspective, we do kind of continue being at risk from some of the criticism. And then the other kind of point I would make is just around the disclosures, and we do have a lot of clients that are reliant on those disclosures for their kind of passive type approaches, and they are really concerned about how much that data is going to continue to be available for them from US companies going forwards, because so many US companies are actually kind of pulling back on their reporting. So they're concerned that they won't be able to actually those strategies will be kind of hard to continue to kind of manage because the data points won't be there. We're not, we're monitoring this really closely with the kind of the databases that we have internally, and we're waiting to kind of see with the next round of corporate sustainability reports how significant that drop-off is. But I think it's a kind of another interesting point that we haven't really touched on is what's happening in the US.
Did I understand you well that you said, well, you could have made those targets anyway, so I disregard them. I disregard the effort. Is my understanding correct?
No, it's more saying that just categorizing targets by those that are relatively easy to achieve versus those that are very much conditional on conditions that haven't been met.
Right. I'm not sure I would care for the split. Ultimately, I would care for the impact and the alignment with the overarching target. If you look at the boom in EV and solar panels, they've been massive, very important, and with great impact, helping us to align our targets with the end goal. I don't think that success requires pain. On the contrary, if it doesn't require pain, it's probably being more successful quicker. So I don't see that. Always trying to understand the business side of things and the front office and how do they perceive it. So you typically see that we try to create targets on both sides. Those that are required, we need them to happen and they may be painful. We need to reduce our exposure to oil and gas, and it is painful and it's costing us. And we're tripling our lending to renewables, which doesn't come at a cost and great impact on society, and we're making a good profit on that. Equally important because we need them both.
As final words before we wrap up, Saskia, of course, happy for you to respond to the questions. And what do you think what do you hope your corporate climate responsibility monitor will say in 5 years? Where do you see kind of your best case outcome?
Another great question, but first I'd like to respond to Alex's question, and I can see your point, Arno, but I wanted to add that the third bucket of targets I think is that there are a lot of targets that are now being backtracked on that potentially in the first place were never really genuine targets and that were never really meant to be backed up by any planning because they were just following a trend. So some of the backlash we're seeing is not really a shift in ambition, it's just more a shift in transparency around that ambition. Building on that, I do think it's quite important for companies to articulate external dependencies and their assumptions in their transition planning, and I think the next generation of transition planning requirements is requesting that from companies as well. Building on that disclosure, though, I think it would be really important for companies to actually understand how they can also influence some of these dependencies, because we've heard a lot about oh, I can't do this, I can't do that. And at the same time, companies are lobbying against a lot of the regulation that would push for whatever, it might be EVs, we can talk about EVs, a technology that's already available, maybe not scalable due to economic accessibility challenges and infrastructure challenges. However, it's much further than other sectors, and at the same time we still have companies lobbying strongly against those policies, although the direction of travel is clear. So sort of summarize that up, yes, disclosing those dependencies, but also acting on those dependencies and playing a role within that systemic change if the system's not set up for that, for those assumptions to become true yet. And then finally, what would I like to see in 5 years' time? In 5 years' time, 2030, it's a really critical year, and I think we would like to see really ambitious action on emissions reductions, and these need to be underpinned by whatever technologies are already available, but also signals to other parts of the economy of what still needs to happen. We need to be clear about that by 2030, because if we're not there yet on what we still can't do, then where are we headed? We're headed towards beyond 1.5, we're headed towards 3 degrees, who knows? And so I think, yeah, leveling up that ambition, but also leveling up that action within the next 5 years is really important.
Wonderful, thank you. All right, well, thank you to the panelists. Thank you to everyone in the room for the exciting questions and engagement. It leaves me to summarize, but I already half-heartedly did in the previous round. I think is really interesting to see the impact versus risk, the short-term versus long-term, the global reference versus internal thing. And of course, I think I was, to be honest, personally quite struck with how much optimism there is for a continued very prominent role for targets, because I think when we have the broader conversation, it feels like everything is kind of moving back, but it seems, I think, clear from the panel, despite some obvious differences in prioritization or in sort of approaches, that if we want sustainability in some form or another, you have to kind of define what you're trying to achieve with it, and targets are just the way to do that. We don't want to necessarily go back to the 90s, but it's sort of one of the most famous songs of the 90s reminds us is that there is a question here whether targets should be focused on chasing waterfalls or sticking to the rivers and the lakes that we're used to. I think everyone that is trying to set targets moving forward is going to have to answer that for the question for themselves. Look forward to seeing some of the thoughts at the drinks later. Saskia mentioned backlash, and backlash will be the theme of the final session today. It's the Oxford Union-style debate we will be having in an hour in the Sheldonian. So encourage everyone to stick around for that. I am biased as I will be one of the people debating, so obviously I've got skin in the game. But it is genuinely, I think it's fair to say, one of the most fun parts of the summit, and of course there will be a dinner and drinks afterwards as well. So I think there's still quite a lot of opportunity to exchange and to have conversations. So hope to see you all there. Please give a very warm, loud, and generous round of applause to our panelists. Thank you.